Welcome to Smart Money, where we talk business strategies and how to grow your income. Did you know that you're more likely to be killed by a champagne cork than by a poisonous spider? But how are you most likely to die? Well, according to the World Health Organization, you're most likely to die from heart disease. That's one of the many reasons that I decided to invest $100,000 in an artificial heart valve. An investment of this caliber in a private startup company is called an angel investment and can often yield returns of 20x to 50x your initial investment in a time span of 2 to 5 years. Today, I'm going over what you need to know to get started in angel investing and a few secrets to help you identify the best startups out there. If you're new here, be sure to like and subscribe. I read and respond to every comment. Enjoy the video, guys. So how does angel investing work? Well, let's say that your really smart childhood friend is building an innovative computer in his garage, but he needs $10,000 to buy the initial parts. You go ahead and agree to give him that $10,000, but for 1% of the company, valuing his company at $1 million. Now, it turns out that that friend of yours is Steve Jobs, and his project was the first Apple computer. 5 years later, Apple's worth $1 billion, and your 1% grew in valuation from $10,000 to $10 million. The real question is, though, how do people like us that can't really afford to throw around thousands of dollars so easily get into angel investing? Well, the easiest way that you right now can invest in a private company is by investing in a publicly traded private equity fund, which is really a company that specializes in buying, growing, and then selling private companies. The downside to this, however, is that the private companies that the private equity funds invest in typically are larger and at a later stage than your average startup, which means that when you invest in them, you get a smaller piece of the pie. And a smaller piece of the pie means that the returns are not as high. If you want to invest in a private company directly and reach some astronomical returns, if you want to be an angel investor, then I'm going to explain to you guys exactly what are my best tips for finding the right company to invest in. But first, just to give you guys some background on my experience in angel investing, I was actually born in Israel, which has the most startups per capita of any country in the whole world. I also had the humbling opportunity to travel to Beijing and Hong Kong to raise money from ultra high net worth individuals in order to invest in some of the best startups here in Israel. In doing so, I had to do research on lots of private companies and find the ones that are most likely to succeed. Based on my mistakes and my successes in the industry, here are my top 5 tips on how to identify the best angel investment so that you can come into the industry more prepared than I did. Number 1 is to identify a startup through somebody that you trust. That means that if you heard about an amazing idea, but from somebody that you just met recently, they could really screw you over. I swear that in the end of the day, business a lot of the time is about one person screwing over another, so you really have to be cautious of doing business with people that you don't trust.
Daddy! Kath, oh no! Ow! Oh.
Number 2 is to do research on the industry that the startup pertains to. You'll see why this is super important in just a sec. Number 3, and the most important lesson that I learned from angel investing, is that once you identify a startup, don't invest in it. Instead, ask your good friend to schedule a meeting between you and his investors. Now, it's obviously important to make a humble and friendly impression with these investors, but the business motive alongside it is to ask these investors what they're investing in. They'll usually be more than happy to tell you all about their portfolio and exactly what they invest in, because if you invest in one of their portfolio companies, then the value of their equity in their company increases, meaning they make money. The point here is, though, that now you have a sea of companies at your disposal that these investors will be happy to introduce you to. So let me tell you a secret. Most angel investors invest in their first option because they don't have any other options. And this is a way to create more options. So now that you have a sea of companies to choose from, do your research and pick the one that you think is the best. But don't invest in it just yet. Before you invest it, see if somebody else is willing to, because that will minimize your portfolio risk. The idea is to pitch the startup that you found to every single person that you know that may have money to see if they may be interested to invest in it. This is where doing your industry research is extremely important, and this is where being a good salesman is also very important. So once you found an investor, you're going to tell him that you've identified a really good investment opportunity. But before you reveal to him exactly what the opportunity is, you're going to tell him that if he invests, you want to keep a percentage of the profit. This is called the finder's fee agreement and is exactly how I sold Israeli equity to Chinese investors. So after an investment is made, you got to wait patiently till there's an IPO or an exit, which may take a few years. Now, before going ahead and actually making angel investments, you need to know the pros and cons of investing in a private company so you don't come into the industry making any rookie mistakes. Let's go over the cons first. The first con is that private companies are not required to provide any financial information to the public, so it may be really difficult to determine these companies' financial soundness, their sales, or their profit trends. This means that you need to have great trust in the founder to perform well. Public companies, on the other hand, must file financial statements with the SEC, making it easy to access their financial health on a frequent and regular basis. The second con is that private companies are not very liquid, meaning they have very long investment timeframes, often between 2 to 5 years. So if you invest 10K in a company, you can't just sell your shares tomorrow. That money is locked up there for years. The third con is that angel investments are incredibly risky. 90% of startups fail, and if the startups fail, there's a good chance you're not getting your money back. But anything that carries that much risk comes along with great rewards, so let's get into the pros of angel investing. Angel investing yields incredibly high returns, usually at least 20x your initial investments, but there are some cases out there where that multiple is way higher. For example, one of the most successful angel investments of all time was Masayoshi-san's $20 million investment in Alibaba in 1999. His stake, which he originally paid $20 million for, is now worth $143 billion.
Billions and billions and billions and billions and billions and billions and billions.
That's a 10,000x return, making him by far the richest man in Japan. Now, technically a $20 million investment is not an angel investment, but I thought it was such a legendary story that it deserved a place in the video. Another pro is that private companies tend to be long-term oriented. This is because public companies are often overly focused on quarterly results and meeting Wall Street analysts' short-term expectations that it causes them to miss out on long-term value-creating opportunities. For example, a company may choose not to invest in a product that would be successful in the future just because it will hurt short-term earnings. All in all, private firms can be better managed for the long term because they're out of Wall Street's reach. The bottom line of this video is that if you invest in the first company that you see as an angel investor, you're gonna have a 10% chance of success. And if you wanna increase those odds, you're gonna have to do extensive research and networking. You have to navigate your way through the startup community in your city till you find the best startup opportunity. In terms of the artificial heart valve that I invested in a couple of years ago, I'm currently under a non-disclosure agreement, so I can't talk much about it. Be sure to stay tuned though, because I'll be posting a video on the outcome of that investment as well soon. With that being said, don't forget to like and subscribe. It really helps out the channel big time and helps me to create content like this for you guys going forward. Thanks for watching Smart Money. I'll see you guys next time.